Welcome in. This is the Investing Power Hour on Chit Chat Stocks. My name is Brett Schaefer, and if you're listening, usually Ryan does the intros, but today we have a special guest fill in for Ryan as he's away on work. It is Paul Cerro, uh, lead investor slash founder slash writer over at the Cedar Grove Management Services. Paul's been on the show before, covers a lot of different types of stocks. We're going to be talking HIMS and HERS today, plus plenty of other things. But Paul, before I hit the rest of the intro, why don't you tell the listeners a little bit about yourself?
Yeah, no, thanks, Brett. So my name is Paul Cerro. I'm founder of Cedar Grove Capital Management, where I specialize in talking about or doing research and investing in consumer, retail, and basically consumer tech names. So a lot of the stuff that you either walk into a store and make a purchase at, or online and make a purchase. Those are the companies I typically invest in and cover. So I've been doing this for a number of years. Started off my career in Wall Street as well as an investment banker. So it's been a very long process and how things have materialized. But always happy to chat with you guys.
Yeah, and yes, yeah, you have great perspective on those type of things. You always have opinions and aren't afraid to voice them. I think one of the frustrating things is when you have someone like a CEO or something on the show, it's great, but a lot of times they can be reserved. And we do
Yeah.
like on these shows giving away our investing takes. And we'll have any links in the show notes for all that. We're going to be talking HIMS and HERS first, but maybe just a tease. What attracted you to the name?
Yeah, that actually goes back a while because when I left Wall Street, the first company that I worked at was at a company called Roman. And I say this loosely because they aren't the same, but like they are the same. It's essentially it's what Hims and Hers is, except they're still private. Um, so I already knew about this business. I was already working for them. I was already doing strategy for them, and I had equity by working there, right? Because it is a tech company. But then after I left and a few years went by, and there was no real sign that Bro was going to go public anytime soon. I'm like, you know what? Maybe let's get involved with him. So I understand the business very, very well. I helped grow the business that they're in. So it wouldn't be hard for me to understand. So that's why I jumped in on this name because I understood it very, very well. And when I finally did, my homework on it many months ago to get brought up to speed, that's when I hopped in and took a position, and I've been following it ever since.
Yeah, it's definitely an exciting company. We're gonna get more into the details there. We're probably gonna try just for anyone that does the typical power hour concept. We'll probably do like maybe a third, maybe 15, 20 minutes on Hims and Hers, and then we'll hit all the other topics and kind of news of the week, questions from the audience, all that good stuff. But first, I need to talk about our presenting sponsor, Public. Are you paying too much for to trade options? If you're not trading on public.com, the answer is yes. Public is the only platform where you can earn a rebate on every option contract traded, and that's in addition to no commissions or per contract fees. There's no one else out there paying trading rebates, so you won't find a better deal. Bottom line, if you're paying more than $0 to place an options trade, then you're paying too much. Switch to Public and start getting rebates on every single contract traded only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in the podcast description. All right, let's run through it. First one, I think that would be fun to discuss, and it's an analogy you've used before with Hims and Hers. You said they may be flying too close to the sun. Why is that?
Yeah, so back in May, they made the announcement that they were going to be going into the compounded GLP-1 market. And for those who don't know, GLP-1s are the newest and hottest drugs out there for weight loss that are FDA approved. However, when you switch into a compounded version, they are not FDA approved. And because there's a shortage going on of these drugs, compounded versions are allowed to be made while the shortages are going on. That does not negate any issues with how people perceive these drugs. It's just that they're technically allowed to do it. So when I made the comment that Hims and Hers might be flying too close to the sun, it mainly stemmed around what was said on the earnings call, the most recent earnings call versus what and other investors had widely determined would be the outcome of the future offering of these drugs. So what do I mean by that? So it was more or less understood that during the shortage of these medications, companies like HIMS can compound these medications, sell them on their website to eligible patients after they've spoken to a doctor, et cetera. And once the shortage would go away, that means the compounding ability would go away, which would then mean naturally you would then just shift to selling the FDA approved medication, the branded version of these medications. That's what many of us were just assuming, right? And there's a difference, right? Because the margins on compounding are going to be different from the margins on branded because you're actually buying from a manufacturer. So what ended up happening on that call, which when I was listening to it live, I was just shaking my head because I'm like, this is not what any of us were thinking was going to happen. But essentially that management decided, hey, even after the shortage ends, we still feel confident we'll be able to compound this drug. And that alone just sent like the hairs on my back like up because I'm like, that was not what was planned essentially in our minds, right? And the problem with that is that even though the management can make a case that's saying there's plenty of precedents for this practice happening in the past, you're operating in a gray area, and when you operate in a gray area in healthcare, you do not want to piss off the wrong people because you really do not have any leverage when you're operating in a gray area. And you have to remember too, they are an online telehealth company, right? Even though it's been around since 2017, it's still a newer concept than you and me going to our primary care physician, speaking to them, getting our blood pressure taken, et cetera, answering questions. It's still a very new concept. So when it comes to the leverage that these companies have, it's basically none. It's not COVID anymore, where you're required to see someone. If the FDA want to drop a hammer on you, they can. If the government wants to drop a hammer on it, they can. If these companies like Eli Lilly and Novo Nordisk, who have an abundant amount of money, precedents, lawyers standing behind, ready to go, you do not want to piss off the wrong people. And them saying that pissed off a lot of people. And that's why I believe, in large part, the market sold off because you're adding risk to something that you didn't need to add risk to. And investors were just not comfortable with it.
Okay, so by going down this path, what's the benefit? Why do you think they went down this path? Even if from what you're saying, like they should rather sell the I don't know, Wegovy as a HIMS branded thing, if that's exactly what they're doing. I know that's kind of what they do for other products where it's essentially we're taking a copycat of Viagra and we're putting our branding on it and selling it in this innovative model. But what was their reasoning? Like if everyone is saying this is so risky, like what do they see as upside there?
Okay, so to be very clear, I'm not against compounding. Compounding serves a purpose in the healthcare space. Um, Again, for those who don't know, compounding is literally what it sounds like. You're quite literally compounding something into something new, or bits of pieces into something new. In this case, you are compounding different components into what would be a quote unquote a new medication, new for weight loss. There are reasons why compounding exists. Right now, it's because there's a shortage. And in reality, compounding works because they labeled it very well. Management did. They said that, for instance, right now GLP-1s are injections. Perhaps you don't want to take medications that you have to inject yourself on a weekly basis because you don't like injections, or maybe you just can't do it. You're afraid of needles or whatever, right? So you can't participate in the current delivery system that's being used right now. So what do? You can compound a new system where maybe it's an oral pill, an oral version of it, right? So now you put it under your tongue, it dissolves, you take it in that way, right? Perhaps there's versions where in the future it could be like a spray, right? There's different reasons why compounding exists that can pull out the issues that you might have that are different than what I might have that would help us be able to take the medication. So compounding as a broader topic makes sense. Nothing against that, no problem. It's been happening. It's been happening. There's precedence. The problem arises in my opinion, and what I've spoken to other people's opinions, is that when you are compounding an FDA approved drug that is still on patent for quite a while, like you got, was it six, at the minimum, you have 6 years left for at least Wegovy's. And then for tirzepatide, I think it's 2033, 34. I always mix up these years. There's too many years in my head. The problem with that is that you still have two manufacturers who have spent a ton of money in R&D, and the natural order of things are the manufacturers who spend the billions of dollars to see if these drugs can become a success will typically reap the rewards for the rest of the patent life cycle, and then generics pop up and you can do whatever you want. HIMS has decided that they feel confident that they can continue doing it because of previous precedents that would be allow them to, I say skirt because that's kind of what it is, skirt the way the natural order of things has been, because the needs of the patients could be argued that a compounded version is necessary. That's what the issue is with compounding, and that's why I had a problem with it. But I want to make that clear because there's a difference between compounding in general versus compounding under what's going on right now.
Yeah, it seems. I mean, we even had someone in the comments here saying, "Hey, interesting take. Management seems to think there's a lot of precedent," which is before you said that. And when I hear a management team say that, it's almost like they're saying the same thing over and over. Like, "No,
Yes.
trust us. It's going to be fine." When in reality, like there are two different scenarios that could play out here where things could go really, really poorly if if it doesn't work out. And yeah, it still could be fine, but it introduces some risk here. Now, I want to talk about, someone asked this as well. Basically, just a basic rundown of your thesis on HIMS. I know that part was a concern, but in general, you seem fairly optimistic about the risk reward here. What is the basic overview of the thesis and how the company works and why you think it's an innovative business model?
Yeah, I think the business model is, it's honestly great. And I don't say that from a biased point of view because I worked for their competitor. I say it because when I took that job at Row, when I was learning about it and deciding to eventually take the offer and join them, I said to myself, I'm like, this is a game changer. Like this alone is a game. I can see this becoming something. This isn't the 12th cybersecurity firm to pop up or whatever. The benefit here for this model, right? Because everybody asks, oh, people say like, oh, there's no moat. Oh no, there is a moat. Oh wait, well, how wide's the moat? Oh, okay, well, how deep is the moat? The business model here is interesting because in the healthcare space, the U.S. healthcare space, the U.S. healthcare space sucks. It is absolutely terrible. So at the very tippy top of this pyramid, you have the value add of being able to speak to a provider very, very quickly, right? If you were to go and try to make an appointment with your physician right now, the odds of you being able to speak to them in the next 48 hours are slim to none. If you needed to go talk to someone on HIMS, again, for the conditions that they offer, you talk to somebody within 24 to 48 hours. That's how quickly you can talk to somebody. So right off the bat, the value proposition is being able to talk to a licensed provider from the comfort of your own home without needing to go. Again, this is for certain conditions because they don't offer everything, but without having to wait a few weeks, go drive out, talk, et cetera, et cetera. So time is an important one. Secondly, the healthcare industry really, for whatever reason, I truly don't understand this, lean heavily on insurance to provide these healthcare services. And that means, and for some people, that could be very beneficial, right? If you can't afford to do something, that's where your insurance comes into play. The problem with that is that it gets overly used because if you were to go to your physician, right, and you were looking for some type of erectile dysfunction medication, right? Like you can get prescribed it, right? And maybe there's a copay with your insurance, again, depending on who it is. But there's always, in the healthcare space, there's always a cash pay option. That means literally you take the cash out of your pocket and you pay them, and that's how you go about your day. There's no deductible, there's no copays, there's no insurance claims. It's just, oh, it's $20. Okay, here's a 20. Done. Move. You're on. The HIMS model has allowed to has allowed patients to go onto their platform, go see or go talk to a provider for the condition that they offer, right? That's in this case, we're using erectile dysfunction. And for a cash pay price, cash out of the door, they can get their medication for dollars and not having to go see someone and potentially go through the hoops of insurance. That value add now can lead to cost savings. And there's an example, and I wish maybe you could tag it in the show notes or something. But there's an example that I posted the other day about PBMs, pharmacy benefit managers, who I think are a disease to this healthcare industry. They essentially help inflate the cost of medication to everyday people like you and I, because that's the way the system works on an insurance coverage basis. Whereas if it was from a cash pay basis, it'd be much cheaper. So that's what HIMS is doing. It's like, hey, you like the condition? You can talk to a doctor really, really quickly. You can, if you are eligible, you can get prescribed the medication. We're going to offer it to you at a very attractive and affordable cash pay prices, and we'll ship it to your door with free shipping. I think it's like 24 to 48 hours, again, depending on what it is and where you're located. So it's speed, it's discreetness, it's the cost effectiveness. It keeps piling on. And the more you go down that food chain with conditions, the more advantageous it gets for people who have multiple conditions, or for people who don't have insurance, for people who can just benefit from being able to take a compounded version, which is what they've been doing, right? So on a business model basis, there's a lot to like. And I'll pause there because I know I was rambling for a little bit.
No, I mean, that's a fantastic overview. What's interesting is that given how frustrating it is to work with the insurance part of the industry as a consumer, and I'm sure as the providers as well, the bar is so low and they can still be at a higher price point, at least from what I remember researching it earlier this year. I haven't kept up with them that closely, but they can say offer something that might be more expensive than you would have if you
Yep.
were dealing with insurance, but the time
Yep.
saved and the headache saved, it seems like the overall value proposition is there. I'm going to share a slide here from our friends at FinChat. Oops, one sec. And it's basically showing the gross profit growth since I don't know, I think it's 2017, 2018. Essentially, then
Yeah.
they weren't really earning any gross profit, but still the revenue's grown at a similar rate. And since 2018, till the last 12 months, gross profits grown from under 10 million to closing in on $1 billion, compound annual growth rate 136%. I mean, this is one of the most impressive growth stories out there, perhaps still underappreciated. I think the question everyone would ask when looking at this is, okay, can this continue? Have they hit the easy? Because I know people talk about them really just offering a lot of, like erectile function dysfunction stuff and ADHD medication and stuff like that. And maybe has that market been saturated, or like,
Well, I will
you know what I
correct
mean?
one point. They don't sell ADHD medication. I will correct you on that point.
Okay, okay.
That's an area where even I have issues with. But to your point is the healthcare industry is there's gonna be people who disagree with me on this, but the healthcare industry is set up in a way to disguise itself as helping the everyday person who has insurance, but it's set up to not be the most advantageous for patients. And the example there is I gave with the pharmacy benefit managers who hike up the prices because that's the way the natural order of flow works between drug pricing and manufacturers and pharmacies, et cetera, et cetera. Um, so when you're looking at what they're disrupting, it's that entire flow. Is we can get more affordable access to healthcare to people who need it without having the need to go through insurance. And again, the more you use insurance, the more premiums go up, right? The more unhealthy you are, the more health insurance premiums go up. So that's what they're disrupting. That's what's making them successful. The second that they probably go into insurance is the day I will probably dump my entire position. I have zero interest in backing a company who wants to go into the insurance business. If they take insurance as a form of payment, honestly, I'm out. That defeats the entire purpose of this business model. Um, That's number one. So when it comes to the future, though, to answer your question, when you're making this startup from the beginning, if you don't take insurance and you take cash pay, you have to go for conditions that are large, whale size, that has a huge market that you can penetrate into. They did a very excellent job in picking a condition that has very high a stigma attached to it, right? So if you talk about erectile dysfunction, that's a very touchy subject to a man, right? If you tell a guy, hey man, I can't get it up, that's a very like self-esteem hitter to you. So what do you need? You want to make sure you get help discreetly, which is exactly what they were doing, right? You see someone online, you don't go to the doctor's office and be like, hey doc, I drove all the way here and I can't get my John up. It's kind of depending on who you are, right? It's the meaning. So there's highly stigmatized conditions that can be cash pay, that can be done online, right? Because not everything can be done online. And you start from the biggest and you work your way down, right? So you have erectile dysfunction, then you have premature ejaculation, then you have hair loss, right? Then you have for like women, it could be like your eyelashes with Latisse. It could be like skincare. Maybe you have eczema or some type of acne. You can get your birth control prescribed online, right? You keep going down the list because you start from the biggest. You keep going down the list with other conditions that might actually be a side condition of a primary condition, right? So like people who are now, it's like people who are overweight have problems with erectile dysfunction. So you can be treating, two things with one or one thing with two things. You know what I'm saying? So it's a combination of things now. So like the more you keep adding onto these conditions strategically, you create this platform effect where I came in for one thing initially, but in 2 years, you've launched three different things that now I can apply to, right? I can get my hair taken care of. I can get my erectile dysfunction taken care of. I can get my weight loss taken care of. That's how it keeps going. But there is a limit to how successful that can be.
Yeah, totally makes sense. I mean, and you're not going to grow at 100% forever. We have a
No.
couple more questions. Like, revenue growth, the rate of revenue growth is gonna slow down eventually. I have a couple of follow-ups here for some people that I think make a lot of sense to ask about. Here's one that I think is interesting. Would HIMS have been better off skipping GLP-1s? Maybe I'll
No.
say right now.
No.
No.
At this point, the news that came out yesterday with Eli Lilly, 94%. It dropped the conversion rate of pre-type 2 diabetes patients by 94% of crossing into diabetes is insanity. You've never seen numbers like that. For a drug to have that effect is crazy good. Crazy good. So when you think about how successful these drugs have been, it would be irresponsible not to go into that market, right? I think, depending on who you ask, I think there's a difference between staying the compounded route versus going with the branded products, right? The branded Wegovy, the branded Zepbound, the branded Manjaro, the branded Ozempic. But it's table stakes to be, if you're in healthcare right now and you're offering these drugs or you're trying to help these conditions, you need to be in this market. That's just what it is. And hopefully you're doing it in a responsible way.
Makes sense. Yeah. And what do you think about their marketing leverage? I know when I looked at them, they weren't burning a lot of money at the time. I think they're pretty close to break even actually, but the biggest expense line was marketing. They said they were going to keep growing them because they believe that they're acquiring really, really valuable customers and that given their scale, they can kind of push out a lot of the startups that don't have the firepower they do. What do you think about that strategy and their talk about, customer lifetime values?
No, it makes sense, right? So in the very beginning, it's very questionable because when you're trying to prove a new concept, marketing is going to get very, very expensive, right?
Yeah.
Telehealth was a new concept back then. It's like see a doctor online, no, scam. Over time, though, what really juiced things was COVID. If COVID didn't happen, we would not have seen the pull forward in adoption of telehealth that we did. So when you think about what the future can be, um, with the marketing leverage, they're in a very good position because they've had the years and the reps to build up the platform to almost 2 million subscribers. So that when it comes to adding in a new condition, they're spending in aggregate, they're spending less because they probably already have somebody on the platform who suffers from that new condition. So it's not spending $100 to acquire 2 new people. It might be spending $50 to acquire one person because one person's already on your platform. You know, but what's interesting, and I tried pointing this out on Twitter before everyone starts ripping me apart, is that it's such a competitive space that the bidding for the keyword searches, right? Whether you're bidding for the weight loss keywords, GLP-1s, Zepbound, whatever, it's gotten more expensive because it's such a hot market right now that so many companies are being involved that it's just getting more expensive. And I brought up a very important fact that, like, if you look at the aggregate total spend on a quarterly basis for marketing and the net subscribers that are added on a quarterly basis, it's actually getting much more expensive for them over the last 5 quarters than it was the previous 5 quarters, which, if that trend continues, is not a good trend. That means their customer acquisition costs are going up. So even though broader marketing expense as a percent of revenue is going down, that does not mean that it's getting cheaper to acquire customers. It just means that the dynamics have shifted about where that revenue is coming from and how the marketing is being spent.
All right, two final questions because we can't talk about HIMS for this entire show. We'll get some other topics here.
Yep.
But for anyone, we're not going to talk valuation much, but for anyone interested, definitely go check out Paul's Substack and then the Twitter/X account as well. All the links will be there, and I'll have them in the show notes. You're pretty active on Twitter, so you have all the links there and on Substack as well. The questions are, what are the biggest risks for HIMS, or maybe the one biggest risk? And does it have a competitive advantage, or are you thinking it will build one over the next however many years?
You mean competitive advantage
Just
in
just kind of
broadly speaking?
any competitive moat that investors
Oh,
can bank on. Yeah.
yeah. So to answer your first question, the biggest risk that I see right now, it was always lurking in the background. So I'll give you two. There's always lurking in the background, which is regulation, right? If you take a concept and you do wrong by it, like I said, you don't have any leverage. The government will come down and drop a hammer on you, and they have, right? If you look at um, Dunn and Cerebral, who are both, that's essentially pill mills for ADHD medication. When the DEA raids your offices, you are not doing right by patients. You are
Not
doing
great.
right by your business. Yeah.
Yeah.
So regulation was always a thing, right? Bad apples create bad outcomes for everybody, especially when it comes to healthcare, because people's lives are at stake. You don't mess with that. That's always in the background. But the real risk that I have now, which I wrote about in my report to everybody, is that if you're going to continue operating in a gray area, you better have certainty that you can get away with operating in a gray area, because otherwise, like I said before, you're going to have armies of lawyers who have mounds of cash behind them to sue you into oblivion. Even if they lose, they can still sue you for a very, very long time and keep you tied up in litigation. Or if you screw up a little bit, government entities, the FDA, will come in and be like, no, you need to stop, cease and desist. You're not, it doesn't matter if you own pharmacies. It doesn't matter. We've had complaints, we've had risk to patient health outcomes. You're done. That is now the problem. I'm not saying they're not doing a good job at all. I'm just saying that is now, the dark cloud that is over the company at the moment.
All right. And what about the moat? I know it's a young company,
Oh,
so
right. Sorry. Yeah. So the moat. No, they have a moat. No, it's. I think it's silly to say that they don't have a moat. I know there's people who come in here and say, like, why wouldn't another company just come in and spend, tens of billions of dollars or tens of millions of dollars on marketing and, win? It's like it's not that easy, right? Because then when you think about current existing players, they already take insurance. When you're mixing an insurance business versus a cash pay business, those two don't mesh. It's like trying to grind two rocks together and, trying to get some type of outcome other than sparks. Um, so when it comes to a competitive moat, their ability to be in a market where they have built up, again, almost 2 million subscribers, treating various different conditions for a long time now. They've built trust. They've built they've established that the treatments that they offer for their conditions are efficacious, right? They've offered that quick turnaround time of seeing a provider. They've offered the quick turnaround time of getting your prescription medication sent to you, and they've shown that over time, they will continue to add new conditions. So even if you can only factor in for one today, that does not mean it's going to stay one tomorrow. So there's a lot of things going for it. I'm very excited to see what the future holds, but no, they have a moat, and if anyone tries to go into that, it's going to be a very costly one to like dethrone them.
Right. It's not something you can replicate overnight. You could replicate the marketing
Absolutely
spend,
not.
but you couldn't replicate everything else they have in it. What's interesting and what I got kind of got excited about looking at them this spring is the fact that there's a lot of potential to expand that moat over the next 5 to 10 years. But yeah, that was a fantastic discussion. We're going to move on. If anyone is interested in the live chat, I put the link to the Cedar Grove Asset Management Substack, and then I'll put that in the show notes as well. You can definitely find any of these write ups across the newsletter website. But the best place, and I should say, for finding all sorts of write ups across the internet is our second sponsor of today's episode, and that is Yellow Brick. This episode is brought to you by our friends at Yellow Brick Investing. It is an aggregator of the best stock pitches across the internet. They track thousands of blogs, newsletters, fun letters, podcasts, and more. They collect and summarize the best stock pitches and bring them to you in a single place. Think of it like a modern value investors club, but much better. We genuinely use Yellow Brick over every single week, really, at Chit Chat Stocks to discover new small cap ideas, especially ones that are undiscovered that people have written about that we wouldn't find anywhere else. Try it for yourself. Go to yellowbrick.com. Excuse me. Join yellowbrick.com/chit chat and search a company or ticker you're interested in. That's joinyellowbrick.com/chit chat. All right, Paul, what do you want to talk about? Any earnings that seemed exciting to you? I know we're pretty much done with earnings. Nvidia's kind of a I don't like that they're a $3 trillion company that reports on on August like 28th, but any earnings that found, positive or negatively that were interesting to you this quarter?
Um, because it's funny. It's not so much that because there were ones that I was um, trackers for my own purposes because I have a position in them, which they've worked out so far. But what's interesting is that like Peloton is coming up um, tomorrow, actually, I think, and that is one I know you and I have chatted about it, or it's the very least you see me tweet about it quite often. Um, and I think that if we don't get positive outcomes there tomorrow, I really don't know what the future of this company is. But if we're talking about like companies that have reported, like even like Macy's today, like Macy's was interesting. I think it's getting sold off. What was it like 10%, 12% right now? Something dumb. Home Depot, Lowe's not doing so great. It's kind of like a warning sign. Hey, people aren't going to be um, doing home improvement projects as much. Uh, there's only so much you could blame the weather for, right? So it's like what's really happening. Then you get the labor stuff going on right now with the revisions this morning. There's a bunch of stuff, and honestly, it gets more confusing day by day.
Yeah, because if you look at those ones on the negative side, you have then Target posting pretty good numbers, Walmart
Yeah.
posting pretty good numbers, Amazon posting pretty good numbers. Maybe those are I think the perma bears might argue that, oh well, people are just trading down and that then the recession is going to hit after. But I've come to learn that we should maybe just look at those as almost a 50-50 coin flip because these same people have been calling for a recession since the end of 2021 or basically when interest rates started going up. And maybe they'll be right over the
Well,
next
that's the
year,
thing.
but they've been wrong so far. So it's like, okay,
I
I
will
don't know
add
yet.
that because for context, yeah, you know this. Like I was bearish in 2022. I was like, you know what? This time is running out, right? There's only so much that consumers can handle. And you know what? I will eat my words. I was wrong on that. It seemed that the excess savings did not dwindle the way that everybody thought they were going to dwindle. The pullback in spending did not occur like everybody thought it was going to occur. And that's why you have, but now what you see in 2024 are the hits and misses for these companies, right? You had Walmart doing great. You had Target finally reversing after how many declines over
Right.
the last couple of
It was a
quarters,
pretty
right?
easy comp. Yeah.
Yeah, okay, there's that, right? But then you have certain companies that still don't make sense to me, right? If you're looking at Kava's valuation, who is bidding up Mediterranean bowls this much? It's a $14, $15 bowl. Why are you paying $33 million per store when it only generates less than $3 million in revenue? Like, what are we doing here? And then you have uh, CEOs getting shot left and right. Like with Starbucks getting out and then pulling Chipotle's CEO. Like no one saw that coming, right? So you're just seeing cracks in places, and I think everyone's still trying to determine, is that because there's a broader fundamental problem in the consumer, or because the what's the expression, the rooster has come, the crow has come home to roost. I don't know, some farm analogy where like the day of reckoning has finally come to these companies who are just poorly managed, right? We don't know that because there's so much noise going on between companies that are doing well, companies that are doing bad, and companies that are just alive, right? And I think that's the problem. And I think if anyone has any confidence one way or another, I feel like they're just trying to sell you something. But that's my opinion from a former bear turned not bear.
Turn neutral.
Turn
The
neutral then, yeah.
Yeah,
Cautiously neutral.
it's funny enough, we did have a question on macroeconomic stuff. Tyler does ask these questions. Usually Ryan and I don't follow that much, so we don't have much comments, but I know you follow it a little bit more. Here's the question. You kind of talked about it a little bit. Does he think we are entering a recession given the triggering of the SOM rule? Can't say I know what that is. The slowing labor market and the inverted yield curve. One thing I'll say
Yeah,
before you start,
yeah,
the inverted yield curve I find interesting because it's been the longest in
yeah.
recorded history.
Yeah, actually, I think if I can pull up the spreads, I think the 10-year 3 month is still inverted by a lot. I think recently the 2 10s became uninverted for like a minute. Um, but no, to his question, it's like, yeah. So I wrote a report on the SOM rule, except I broke it down a little bit more, right? So the SOM rule is based on a national level about the moving averages of unemployment over time. Yeah, it got triggered this past month. And historically speaking, yeah, I think it's had like maybe like it's had one false positive, but the thing is, it wasn't false because the recession came 2 months later. Um, so it was like a delayed reaction, I guess. So on a national level, what I mentioned in the report is that, yeah, SOM got triggered, which would then mean, okay, we're entering recession. Here's the problem though. When you look at the fundamentals of how employment has changed in this cycle versus previous cycles, it's actually pretty dramatic. And what I mean by that is due to immigration. If you look at state level data, there has been a ton of states that have seen a very sharp rise in immigration, which has been skewing unemployment figures, right? Because you're getting a surge in manpower that otherwise would have been sending things the opposite way. But because they're keeping things afloat and adding to the economy in one way, shape, or another, at a state level, it doesn't look bad. And that's what Claudia said too. Claudia, who's the person who came up with the SOM rule, she said, listen, I know it's being triggered, but you need to not treat that as a binary outcome because of what's happening underneath. It has not really happened in previous situations. Um, I am nervous about a slowing labor market. Don't get me wrong. I think I think the numbers that came out this morning kind of allude to that. But it's nervous because I talked to my friends. Some of my friends have been without a job for sadly like 6 months, 7 months, some are even longer than that, and I feel bad for them. It's not they're unqualified. I mean, these are my friends, ex Wall Street friends, current Wall Street friends, MBA friends. It's tough, and you hope that the dominoes don't continue falling, because if they do, I don't know if the outcome's going to be a good one. So I am nervous about that, but I just don't think the SOM rule right now is the cleanest indicator, and that's mainly just because of what's happening underneath the hood.
All right. Yeah. Just with all those things, there's so many variables. I mean, we just had the last 2 years, the introduction of AI that could potentially lead to people or to companies not needing as many back office workers, stuff like that. And there's also just a bunch of other things on top of that that could impact all these things. But I will say, I don't know why I have this feeling, but compared to 2022 or 2023, I guess I would be way less confident proclaiming that a recession won't arrive, because it seems like there's been a lot more weakening from the company's perspectives this year. Although it doesn't look absolutely terrible. I mean, we still see things like, for example, I think a good indicator would be, or good indicators are Booking.com, Airbnb, MasterCard, Visa, American Express, they have really, really good indicators on the full economy, and they're all slowing down. Now they're still growing, but
It's
it's not as good as
decelerating.
they were
Yeah,
1 or 2 years ago. Some of that's inflation. Like, I mean, this is why these can kind of get circular because it's like, okay, well, how much is it is inflation coming down? How much of
yeah.
it is the actual consumer, the health of the economy? It
Well,
all
I mean,
seems like a mess to me, but
Twitter's filled with opinions on it, right? Because people
yeah,
will show car delinquencies, they'll show credit card delinquencies, but then you zoom out, they'd be like, okay, but like, which age groups, right? Which regions, right? How about in aggregate, right? There's always a counter argument to an argument, whether you're a bull or a bear, and it's tough because like there was I forget who it was, but he's dead on accurate. There is more satisfaction in being right to a downside than there
yeah,
is being right to the upside, even
yeah.
though the reward is usually not as advantageous because again, a broken clock is right 2 times a day, but what did it take you to get there? You know what I'm saying? So it's one of those things where I think there's so many people who want to be like, yeah, I'm right. This is the inflection. We're heading lower. Okay, and if you're wrong, which I was wrong in 2022, you can miss out on an epic run, right? And to kind of prove my point, I could be cautiously optimistic on the economy right now, and I have my worries, right, with labor, but a lot of my portfolio is discretionary names. It requires people like you and me buying things. So if I'm holding those names, I either A, don't understand the risks that are happening right now and I'm completely wrong, or B, I'm comfortable that if there is any type of event, these companies are well structured enough that they will recover and I'll be fine, right? Um, Lululemon being one of them. So it's
I mean,
it's
the
one of those
expectations on that
situations.
one have come down so much. So
Yeah, I mean that's its own Pandora's box. But I wouldn't be in those names if I didn't feel like the long-term success of them was a very viable outcome. And that just proves a point because in recessions you want to stay as far away as you can from discretionary.
okay, I'm gonna share this chart here. It was tweeted by Modest Proposal, anonymous account on Twitter, and I believe it's from some sort of investment banking deck. For the listeners, it lists. I think it's probably something on Amazon just because they're highlighting Amazon here, and it lists their peers. They include DoorDash and Uber in here, which may be a bit aggressive, but they basically have Apple, Microsoft, Google, Meta, Uber, DoorDash, Netflix, Walmart, Costco, and they do an estimate on 2026 free cash flow per share. They do an estimate on 2024 through 2026. So I guess that'd be a 3-year free cash flow per share growth or essentially earnings per share growth. And then they have their estimate for 2026, or I think it is 2026 free cash flow multiple based on today's price. I think that's right. And then they compared it to Amazon. Now, there's a lot of numbers on here. I think what's interesting is the only company they predicted less than 10% free cash flow per share growth is Walmart at 9%, when buybacks aren't really even going to help these uh, stocks that much. But I'm curious what you think of this table and anything stands out to you as too extreme or makes a lot of sense.
I mean, Walmart's getting hit because of the rising costs associated with running their stores. Um, they tried doing those like those self-checkout lanes and stuff like that. It's not working out. You keep seeing all those ghetto videos of people doing things in Walmart, whatever. But like Walmart's still a great business. Costco, that one's always been interesting to me because people keep bidding it up, and I think it's for so long people were anticipating the hike in membership prices, and then it finally came, even though it was so minuscule. It was kind of like a nothing burger. Um, Netflix killing the game in streaming. Dash, I still don't know how Dash is a thing. I shared a post about like how much extra it would cost you to order from Dash if so you just picked it up, and it's 100%. Like how many people can continuously do that on a regular basis? But at least
Oh, yeah,
for
I
the
agree.
top,
Yeah.
at least for the top four, what so Apple, Microsoft, Google, Meta, it's one of those situations where like yeah, they're spending a ton of money on R&D for AI, mainly because they have to. It's table stakes at this point. And if you're looking at some large cap managers, large cap funds, they need to be in those names, right? I mean, you can't be a large cap fund, and not be in those names. Because then how else are you going to explain to your investors, oh, you know what, we missed out on market moves because we didn't hold enough of the top 5 companies. Like you can't
People are
do
afraid
that.
of losing AUM, right? Like
Well,
they'd
yeah, but
rather
that's the
not.
game.
They'd rather chase than lose AUM.
That's the game. And the thing is, like, that's why the passive investing has become a thing. It's like I can't get in trouble for missing out on something if I didn't miss out on it, right? If Apple goes down, that's the broader market. That's the whole market coming down because Apple makes up such a large portion of it, right? The top 5 make up, was it 27% or something like that? It's a massive number. So that's just where I see on that. But I don't know. I don't believe in Apple Team Android.
Yeah, I wish I was team Android, but blue messages apparently from the person that wants that. But uh, yeah, it's interesting. I think my first reaction looking at that chart is I guess I'm always more pessimistic on Apple than the average person, and 15% free cash flow per share growth for Apple doesn't it seems very optimistic to me.
Yeah.
And I think if you look at that, you have to be optimistic on the economy because or just the stock market in general because if Apple grows its free cash flow per share by 15% and then Google and Meta, which are basically like, digital advertising for all of retail spending and whatever, it's a big basis on, or it's an indicator for e-commerce spend, stuff like that. That if they're growing at double digit rates for the next 3 years, the economy has to be fine. And I think Apple, like if we're thinking about consumer discretionary spending, well, maybe I don't know. It just seems to me like those are pretty aggressive numbers, unless you really think that you have some sort of macro take that the economy
Well, I
is going to
mean,
keep growing so much.
if you look at Apple, right? I mean, India is the next biggest market. Granted, it's not as flourishing as China, but there's a reason why they're moving manufacturing, not in mass, but they're starting to move manufacturing from China to India, right? You don't have the risks associated with being a part of the Communist Party over there, and India is so ripe for disruption, right? Which eventually I can imagine, Africa be the next one down the road, right? So you have like these effects here because you look at the American markets, they've raised prices as much as they could. They've tried to launch new iPhones as much as they could. I think you're starting to see this expansion of people holding their iPhones for longer than normal, right? It's slowing down. It's
Yeah.
not every year now. It's every like 1.46 or something. It's getting longer because people can't afford this stuff anymore. Again, it's all noise because we actually don't know what's happening.
Yeah, and I mean the Vision Pro has been a flop. Yeah, I would think
Yeah, that was a
maybe
joke.
that could be someone's thesis for that India and other markets will be somewhere where Apple can take a lot of share. But given the uncertainty of that, I would think that the stock deserves a lower multiple. I do want to talk more about Lululemon. We had multiple people in the comments asking about more thoughts on the Lululemon thesis. But before we do that, I want a reminder on our friends at Public. Let me go find this here. Why can't I find the ad read? Oh, yep. All right. Here we go. Dead air. Yeah. All right. Earlier in the show, you heard us talking about the investing platform public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. All right, let's talk Lululemon to close things out. I think we got a little over 10 minutes here.
Mhm.
I'm gonna pull up FinChat and get some charts up here. Anything, I guess, on the thesis? People seem to think that the woman's business in the U.S. is struggling. I don't know. Do you disagree? Is it more of a just temporary slowdown, or is it kind of? Do you have any kind of unique thoughts on the company?
So Lululemon has done a really good job of changing the game of yoga pants and athleisure for the last 20 something years. 20, no, almost 20 years. Anyway, they
A
make a
long
very
time.
good product. A long time. They make a very good product. Almost all of my workout gear exclusively is Lululemon because it's good. It lasts me a long time, and I just like it. The problem now is that with so much easy success, the recent designs have not been stellar. And JP Morgan pointed this out. Like some of the stuff that they come out with is very unflattering. The colors that they've picked are very uneventful, And when you're comparing it to an aloe, or if you're comparing it to a Viore, which I know is what everybody keeps talking about, they have some pretty hot like designs, So when you're talking about what's slowing down, I'm of the camp that it's more so design, poor design choices, not quality issues, right? It's not like fatigue from Lululemon. It's like if you make something and it doesn't look good, like no, it's a fact of life. No one's gonna buy it, you know. So even though like yeah, even using your chart, they've been doing great, but I think they're hitting a point where it's like the creative director left. What was it earlier this year? It won't be for another few cycles that all the purchase orders from previous maybe bad decisions get run out until new stuff can flow in and hopefully they can reinvigorate interest again.
Yeah, makes sense to me. I really have a hard rule with myself that I don't invest in apparel companies, but Lululemon is making it very hard to follow. I think the stock is gonna it makes a lot of sense why it's gonna work from here. People are really worried about just the next few quarters. And
Yeah.
if you have a time horizon of really just a couple of years, it seems like given their durability over the last 15 to 20 years, they've established themselves and not a flash in the pan. It's been durable growth of the last, I think, decade. I know they had a weak spot maybe in 2015, 2016. And if you look at the numbers, they've grown. And I'm sharing the chart here for the listeners that are watching. I should know that you can get a discount on FinChat using our link, finchat.io/chitchat. Link in the show notes. Definitely check them out. You get charts like this. If we look at their different geographic KPIs, you have America's revenue. It's grown at 6% since February 2020. That might not be the best comp because I think we should probably use trailing there because of just the seasonality of apparel. So if we look at trailing for America's revenue, it's 25% growth. And there's been a slowdown in recent quarters. Yes, women's in North America was probably flat or maybe down year over year last quarter. But if you look at outside of North America, it's been an absolute home run, 47% revenue growth and a really, really long runway to continue that growth. I mean, the Chinese market is growing fabulously for them, and that economy is doing not great right now. It's definitely not firing on all cylinders.
Yeah, it's I would have a different feeling if I know if they didn't make a good product anymore. But their products are still very well made, right? It's not
Like high
like
quality, the material and
yes,
stuff.
yes,
Yeah.
yes. It's not like, oh, they've changed fabrics and now it's ripping much easier. No, it's like no, it's still high quality stuff, right? Yeah, arguably it's still expensive, but you pay for higher quality. That's just what it is.
Yeah. And is the thesis just, hey, look, stock's down, I think like 60%, maybe it's 50%.
I think it's closer to
Earnings
50. Yeah.
ratio is pretty cheap, and they maybe even have some depressed margins right now, and we're going to get a revenue reacceleration once they fix these uh, design problems over the next couple of years. Is it kind of come down to just a simple thesis like that?
I'm hoping so. Because I think I'd be more concerned if they didn't still make a good product. It's just that the designs just suck. You walk into a store. I even asked the person. I walked into the store. I'm like, I feel like I'm kind of just like in a very plain box of Crayola crayons. There's nothing like whoa. Where's the wow factor? You walk into an aloe store and you're like, damn, these are some really cool designs. So you just hope to get into that level, right? So that's I'm hoping to get back on track.
Yeah, you go to a Lululemon store, it's still pretty crowded. People share that all the time. I would
Yeah.
say there's still traffic to all these places, and maybe the throughput's not going as high because, as you said, it's not as exciting as designs right now. But yeah, I think it makes sense. It's a weirdly simple thesis, but one that gets discussed and is almost turned into a battleground stock on Twitter. Although you can turn every stock into a battleground one if you want. We have one question. I know I've been asking you a lot of questions, but I think it's kind of happens like this when we have a fill-in guest for Ryan. What's your favorite company? Excuse me. What's the favorite company that Paul owns, and why does he like it? Tyler is asking that.
Oh, um, it's funny. It's so simple. There's a company that I bought into. It's called Mama's Creations. Ticker is MAMA, and it's grocery. It's fresh deli foods, and they were founded off of meatballs, Italian
Uh,
meatballs, and it's such a simple business model, and the management team has just been executing like crazy. And I think it's probably the company that I worry about the least, but I'm most excited about because there's just so much more runway for them to go. And I think they're up how much in the yeah, I mean granted some of that was an acquisition, that's why you see the large increase.
okay.
But they've been for something as simple as fresh deli food, they have been killing it.
Yeah, still small. I'm seeing 100
Very
million
small.
in revenue, market cap 300 million. Stock has done. I'll do total return.
Yeah.
Even, I mean, even they had a big, really flat period when they went public in 2013 or 2014,
Well, the
and
most important part is there's a management shift
ah,
in middle of 2022, I believe I had that year right. So when you look at the chart from 2022 onwards, you're like, okay, great. I see where the inflection happened.
yeah, we've seen an earnings inflections too. It's quite interesting. I never heard of this one before. Could be a small cap that Ryan could look into. He does a small cap of the week. Yeah, that's
Super
fascinating.
easy to
What?
understand.
Yeah, it seems like it's a consumer goods product. I mean, what's led to the success? You think just the fact that it's fresh? Have they gotten any good distribution deals? What
Yeah,
do you
yeah,
think?
they keep growing out their store counts. They keep growth by acquisition. So they're launching into new product categories from acquisitions. So they do, the meatballs, um, the prepackaged deli foods, olives, salads, et cetera, et cetera. So as the category in grocery stores continues to expand, they're they're a pretty decent player, and they're just continuing to grow. And I think under Adam, the CEO who was brought in, has done an excellent job in the past of turning around companies, and I think he's done a very good job so far. And I'm happy to back him.
Definitely an interesting story. Yeah, and I guess maybe this is more of a feeling on my part, but seems to me like specialty healthy grocery stores like Whole Foods, I guess Trader Joe's is in that mix, but Sprouts Farmers Market. I'm
Yeah,
forgetting about
killer
others.
killer deal on you guys. You guys did great on that one.
Yeah, that has done well. That has done it's done well. But I was thinking that this is a perfect one that would go into these niche players where uh the focused on basically healthier foods and kind of the anti Kroger stuff.
Yeah, I think it's going to actually move that way, right? It's like the people who keep pitching um, HelloFresh, right? Because
Yeah.
the pre-made meals, the healthy pre-made meals. There's a market for something always.
All right. We got, let me see the time here. A couple minutes left. Here's one that Lululemon kind of inspired me to talk about, and it's one that I kind of categorize a little bit in the same, I don't know, stock. It's not the same sector, but it feels similar to Lululemon, and it's one I know you follow or at least are aware of, and it's Celsius, the energy drink brand. I know there's a lot of, I mean, it's a kind of a crazy stock, and some people have done extremely well owning it, and there are some people that are extreme bulls on it, kind of similar to a Tesla fashion. So ignoring that, do you do you like the company? Why or why not? Would it be
I
an
tried.
interesting? Go
It's
ahead.
really funny. When I was working in banking, my VP at the time, sorry, my associate at the time, introduced. This is in 2018. He's like, "Have you heard of this company? It's called Celsius." I'm like, "I've never
Dang.
heard of this energy drink." And he's like, "I'm trying to get them to be our client because I can get a nice bonus check if I do." And it was like a few $100,000 or something like that. I don't think he got it because it didn't, didn't come over. But I think in 2018, I think it was trading at like I don't even know, like single digits. And um, fast forward to like peak COVID, I'm like, damn, I should
Yeah.
have just taken a flyer on that one. But no, I tried doing due diligence on it, and I got different cans, and I was tasting them. And I'm not gonna lie to you, I thought they tasted like crap. I did not like them one bit.
Really?
Yeah, what was it? Yeah, can you go back to 2018? I'm actually curious to know what the price was.
Okay, I can get the actual price.
Oh
Uh,
my God, like a
I guess we can go
dollar?
back to 2019. It was at a dollar. Maybe they did a split, but yeah, I mean, it's been, I think, a 100 bagger since 2018.
Oh
Might
my
even been
God,
below a
yeah, a
dollar.
dollar,
Yeah,
a
oh,
dollar
basically
something.
almost a 50 bagger.
Yeah. So anyway, but no, I didn't like it, and I was like, it just kept going up and up and up on distribution. So in my mind, I'm like, okay, there's definitely a top to this. You you can't go that far that quick without something slowing down. And if something slows down, you get cut at the legs, which which ended up happening. It was enough conviction for me to short it. I definitely was not going to short into that, but I just felt like, you know what, I'm happy to stay on the sidelines on that one. Glad I did. Um, Maybe if I did it in 2018, different story. But yeah,
Yeah, I think it's definitely an acquired taste because everyone that tries Red Bull and Monster, they're like,
ugh,
this isn't good either, but
it's
there's
not.
some of the best businesses in the world, and Monster's one of the best performing stocks ever. I think Celsius is going to be stay on my radar just because of that. I think the category is just really strong. You have pricing power, you have energy drinks are taking share, and Celsius in itself has been taking share in that category. So it's like a trifecta of tailwinds. I think that's gonna do it though. We're at over an hour. Thank you for everyone for asking questions on the live chat. Anything we missed maybe today that you want to hit, or just maybe tell the listeners where they can find you?
Yeah, I think like one parting thought I would say is there's a lot of uncertainty right now, and I go back to the previous example I gave you. People want to be right on the contrarian side of things, but it does not pay out the way you think it would. So never bet against optimism in the long term, right? As long as you know your stuff. Um, and I think that there are still plenty of opportunities out there that are not in the widely covered names, like the Apples and stuff like that. There's too many people covering stuff like that.
And they all
So
trade
if
at 30 times earnings, so it's not too exciting.
yeah, so if you spend a little bit more time just to find stuff, I think you could find some real winners. I mean, I'm up over 60% on my mama position in like a couple of months. There's other names in there as well, but that's what I would leave with. And then, if you need to find me, I'm very active on Twitter. Always feel free to message me on Twitter. If not, you can just go to my research online at cedargrovecm.com. You can see everything there.
Yep, and I will have the links in the show notes for that for anyone interested. I will say, yeah, there's plenty of other Mama's creations out there, hundreds in the US, thousands if you go to other countries around the world. And that can be, I think, much more exciting than chasing NVIDIA. Uh, I think that's going to do it. Thank you to our sponsors, public.com, Yellow Brick, and FinChat. Check out those links in the show notes. Really helps us out if you guys use our links there. And we really think we only have advertisers that we think will actually our listeners would like. So we think people provide value or get some value by checking those out. But let me hit the disclosure. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Paul, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in, and we'll see you next week.